Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Urban Outfitters, Inc. annual report. Urban Outfitters, Inc. offers a diverse range of lifestyle products and services through its various business segments. The company operates retail stores that cater to young adults aged 18-28, offering fashion apparel, activewear, intimates, footwear, accessories, home goods, electronics, and beauty products under the Urban Outfitters brand. In addition to its core retail segment, the company also operates Anthropologie stores, which provide women's apparel, accessories, and home decor items for women aged 28-45. Terrain stores offer lifestyle home products, garden and outdoor living products, antiques, live plants, flowers, wellness products, and accessories. Free People retail stores cater to young women aged 25-30 with casual women's apparel, intimates, activewear, shoes, accessories, home products, gifts, and beauty and wellness products. The company also designs and markets its own brands, including Free People and FP Movement for young women's contemporary casual apparel, intimates, activewear, and shoes. Urban Outfitters brand offers apparel collections. Furthermore, the company operates restaurants and event venues, as well as a subscription rental service under the Nuuly brand. Urban Outfitters, Inc. serves its customers through various channels, including retail stores, websites, mobile applications, catalogs, customer contact centers, franchisee-owned stores, department and specialty stores, social media, and third-party digital platforms. Urban Outfitters, Inc. market capitalization of $6 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Urban Outfitters, Inc. holds a significant advantage in their industry. Urban Outfitters, Inc. trades at a lower price-to-earnings ratio of 13 times and a higher price-to-book ratio of 2.12 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth and decline for a company can be attributed to several key factors. Revenue growth is primarily driven by the expansion into new international markets, which has contributed significantly to the company's overall revenue. The growth of digital channels in North America and Europe has also played a crucial role, as well as the subscription segment through the Nuuly brand. New store openings have further boosted revenue, including Anthropologie, Free People, and Urban Outfitters. Additionally, an increase in non-comparable net sales due to new company-owned stores and restaurants has positively impacted revenue. On the other hand, revenue decline is largely attributed to the closure of 8 stores due to lease expiration globally. The impending lease expiration for a large fulfillment center in Pennsylvania will also have a negative impact on revenue. Furthermore, fluctuations in foreign currency exchange rates have contributed to revenue decline. Decrease in sales or gross profit during peak selling periods has also been a challenge. Interestingly, certain factors have had a neutral impact on revenue growth and decline. The One Big Beautiful Bill Act tax provisions have not significantly affected the company's revenue. Net income and profit margins overview. The net income of the company has shown a significant increase over the past few years. In 2024, it was $287.7 million, which is an 80.1% increase from 2023. This trend continued in 2025, with a net income of $402.5 million and further increased to $464.9 million in 2026, representing a 15.5% rise from the previous year. The profit margins have also improved over time. The net income as a percentage of net sales has risen from 5.6% in 2024 to 7.3% in 2025, and then to 7.5% in 2026. Similarly, the gross profit percentage increased from 34.7% in fiscal 2025 to 36% in fiscal 2026. The operating income rate also saw a significant improvement, rising from 8.5% in fiscal 2025 to 9.8% in fiscal 2026. The reasons behind these changes are attributed to improved retail segment markdowns and the company's ability to leverage its store occupancy costs and delivery expenses. This has led to an increase in gross profit dollars, which in turn drove up operating income dollars. As a result, the net income and profit margins have shown a substantial improvement over the past few years. The company is generating a significant positive operating cash flow. This trend is evident in the financial statements for fiscal 2025, where net cash provided by operating activities reached $502.8 million. Furthermore, the increase in cash flows from operations in fiscal 2026 suggests that this momentum is continuing. The company's ability to finance its capital expenditures through operating cash flow and existing funds in fiscal 2027 also indicates a strong financial position. Overall, these indicators suggest that the company is generating sufficient positive operating cash flow to support its growth and operations. The company's performance across various segments and regions has been mixed. On a positive note, the retail segment has excelled in terms of efficiency and customer satisfaction, with timely checkout processes and high-quality customer service. Additionally, the digital channel has performed well, boasting high website and mobile app availability, accurate customer lists, and swift merchandise delivery. However, there are areas that require improvement. The wholesale segment has struggled to compete with numerous other companies offering similar products at competitive prices, resulting in a decline in performance. This suggests that the company needs to reassess its wholesale strategy to regain market share and stay ahead of competitors. Management is optimistic about the company's outlook, with plans to expand its physical presence through the opening of approximately 14 Anthropologie stores and 13 Free People brand stores. This growth will be complemented by digital expansion, both domestically and internationally. The company aims to achieve future store growth through domestic and international expansion, including new markets and franchise agreements. Management anticipates that these investments will generate positive cash flow within a year, with capital expenditures of $475 million in fiscal 2027. In addition to expanding retail locations, the company plans to invest in logistics capabilities to support its growth strategy. This includes investing in new products, markets, and brands, as well as repurchasing common shares to return value to shareholders. Overall, management's strategy is focused on driving long-term growth through a combination of physical and digital expansion. The company has made significant investments through its acquisition of a large fulfillment center. In March 2026, the company purchased a 1,024,000 square foot facility located in Raymore, Missouri. This strategic move is expected to enhance the company's operational capabilities and improve its overall efficiency. This acquisition marks a major milestone for the company as it continues to expand its footprint and increase its capacity to meet growing demand. The new fulfillment center will provide ample space for storage, processing, and shipping of goods, allowing the company to better serve its customers and stay competitive in the market. The company's financial policies have been scrutinized by investors and analysts. One key aspect of this scrutiny is the company's dividend policy. According to available data, the company has chosen not to pay dividends to its shareholders. This decision may be influenced by various factors such as the company's growth stage, cash flow management, or strategic priorities. In terms of share buybacks, there is a notable absence of information in the provided summary. It can be inferred that the company has either not engaged in any significant share repurchase activities or has chosen to keep this aspect of its financial strategy private. There are concerns about inventory buildup and supply chain disruption in various aspects of the company's operations. On page 8, it is noted that there is a risk of inventory buildup but not supply chain disruption. However, on page 9, potential inventory shortages and their impact on customer relationships are highlighted. The situation becomes more complex on page 10, where concerns about increased tariffs, trade restrictions, labor issues, transportation capacity shortage, and fluctuating raw material prices are mentioned. These factors could lead to significant disruptions in the supply chain. Additionally, seasonal fluctuations affect inventory levels, as noted on page 11, making it challenging to ship merchandise due to commercial transportation curtailment or delay. Damage to distribution or fulfillment centers, as highlighted on page 15, could have a material adverse effect on operations. Furthermore, pages 28 and 31 indicate that the company has significant reserves for estimated sales returns and has experienced an increase in total inventory over the past year. This suggests that there may be concerns about inventory buildup. However, it's worth noting that the company's diverse vendor base of 4,000, with no single vendor accounting for more than 10% of merchandise purchased, may mitigate some supply chain risks. That concludes the financial summary for Urban Outfitters, Inc. Feel free to comment below, and I will be happy to answer them when possible.